Welcome to the fourth episode of the Kiwi DIY Investor. This will be the first episode where we look into a case study of an investment that I've done well in. And the company is called Redhill Education. It's an education provider. It's nothing sexy, but it just goes to show that you can do well of investing in quality companies. They don't have to be the latest tech trend or mining company to do well. The usual disclaimer, this video is for informational purposes only and doesn't constitute financial advice. If you're unsure, please contact a registered financial advisor, and I may have positions in some of the stocks mentioned in this series, and in particular today's one I do currently hold. So Redhill Education, what is it? It's a group of specialist private tertiary education businesses targeting international and domestic students studying in Australia. How did I discover it? It's a small company. I think its market cap is about 150 million. So a tip I have is there's a number of small cap funds that publish monthly reports on what they're investing in and sometimes profile these companies and have commentary on news events. So I keep an eye on some of these, and a couple of them mentioned Redhill Education. So that triggered me to do a bit more research, and it turned out to be a company that I thought would do well. So the tip is to piggyback on those who do it for a living, especially if they publish their reports for free. So why did I buy it? I purchased it in August 2017 at a price of $1.46. So the education sector had been hit hard at this point in time. So what had happened is, in Australia, there are a number of education providers, tertiary education providers and vocational training schools that were getting loans from the government. So they were signing up students and enticing them with free phones or free tablets to join courses. Then those students would take out loans from the government to cover their fees, and they were enticing students who had no way of completing the courses. They weren't capable of doing it. They'd do this just so that they could get money in the form of loans from the government. Then the student would end up having to bear the costs of that loan when they didn't complete the course and ended up having to pay for it. So there were a number of cowboy operators in the market. In late 2015, the Australian government started to clamp down on that. They made noises that they were going to change the VET student loan scheme and tighten it up. As a result of this, a number of operators lost a lot of business because students were no longer able to get loans for these courses. So in 2016, the government significantly tightened the loan criteria and only allowed courses from approximately 40 accredited colleges to qualify for these loans. This caused a number of education providers to go into administration in the 12 months that followed that, including 3 that were listed on the ASX. So investors in those companies got burnt hard. As a result of this, the share market overreacted as investors left the entire education sector as they deemed it too risky. But there are a number of quality businesses in this sector that weren't engaging in this. So sentiment in the listed education sector turned negative. You can see in the share price graph of Redhill Education on the right that it decreased pretty quickly over this period. The share price fell from $1.50 in October 2015 to 68 cents in February 2016. But Redhill Education was only deriving about 6% of its revenue from the original loan scheme and was not engaged in unethical practices to entice students. And this increased regulation in the sector succeeded in removing a number of the cowboy operators from the industry, and this reduced the number of competitors for Redhill Education. Redhill Education had said from about 2014 onwards that they were always looking for other companies to acquire in the sector. Because in around 2014, 2015, a lot of the companies in the sector were using these unethical practices to grow their revenues really fast. They all wanted high premiums to be taken over. So Redhill Education stated that it didn't see any value or quality companies to acquire during this period, and as a result they invested heavily in new campuses and course offerings. And also Redhill Education had another positive hit because it derived about half of its revenue from international student recruitment and English language courses. So ultimately Australia is competing with the US, the UK, Canada, and to a lesser extent New Zealand for English-speaking international student courses. International events such as Brexit and the election of Donald Trump have increased the desirability of Australia as a study destination relative to the UK and the USA. So this has increased the number of international students that are studying in Australia and learning English, and as a result, more and more are coming to Redhill Education. So what happened? Well, there was strong increases in revenue and profitability. The graph on the bottom left shows revenue and EBITDA, which is a sort of proxy for the profitability of a company. So you can see 2014, 2015, 2016, there was steady growth in revenue, but the EBITDA growth was flat and actually went down in 2016, and this is when they were investing heavily in the course and campus expansion. When they do this, they usually take a hit in the year that they're investing, and in future years when they start taking students into the new course or in the new campus, that's when they get the revenue and profitability gains. But you can see 2016, 2017, 2018, there were really strong gains in profit and EBITDA. And as a result, you have a look at the share price graph on the right-hand side. The share price went up strongly, rewarding the company for the strong revenue and profitability growth. The share price rose to $3.97 at the close of market on the 8th of October. So you might think I've over doubled my money in a pretty short time. I should probably sell. Well, I haven't. With the strong rise in the share price, it now has a PE ratio of about 32. So historically, this would be quite an expensive share price, but this can be justified if the company's growing strong. So I continue to hold because of the following outlook statements in the recently published annual report. And just to note that management publishes these each year, and they have a history of delivering on what they say they will. So they've indicated, you can see the quotes below, that all of their sectors are poised for strong growth in FY19. So as a result, I'm still holding. This isn't a recommendation for you to go and buy it at these prices, but if it sounds like something interesting, I recommend you Google Redhill Education, have a look at the financial statements, have a look at what it does in the investor presentations, and make a decision for yourself. Any questions on this, put it in the comments section. Thank you, and that's the end of this video.